Okay, Matt, I think we can get started.
Okay, great. Well, welcome everyone to our webinar today. It's good to have you here. We're scheduled for a half hour, so if you have questions along the way, there's the Q&A, or we'll show our contact information at the end, and we'll be glad to see if we can answer those questions after the webinar. My name is Matt Brown. I'm the CEO of Wherefore. Wherefore is a cloud-based platform used by product manufacturers and distributors to manage their inventory, compliance needs, material costing, and just generally automate more of their business. Manufacturers have plenty of decisions to make when their business is growing, but specifically when it comes to increasing capacity, there are really three main decisions they need to address. One, do I outsource my manufacturing? Two, should I purchase new equipment? Or three, maybe I should just lease equipment instead. Today, we're going to be discussing what to consider when a company chooses to lease, because there are accounting and finance factors that can come up. Providing advice today will be Sensiba Sanfilippo, one of our accounting partners and a growing company in their own right. Okay, with that, let's get started. I'd like to introduce Frank Balistreri, a partner with Sensiba, and Kevin Burke, a senior manager, and I'll turn the presentation over to them.
Great, thanks, Matt. And welcome everyone. And if you have questions, please run them through the Q&A portion down below. Or on top of your screen, depending on where that's at. And we'll try to get to those through the presentation today. So this was an hour-long presentation that we've shrunk down to about a half an hour. So we're going to cover a lot of material, and I expect that there may be some questions. So to the extent you have them, please send them in, and we'll try to get to them, or we will follow up with you after the presentation. Here's just a little bit about SSF. So we're a full-service accounting, consulting, and advisory firm. We used to have a bunch of offices in Northern California, but we've taken advantage of the pandemic to actually close a couple of locations and really go a little more virtual. And I think we'll probably stay that way for the foreseeable future. But the great thing is I now have people located all over the US, and we serve clients all over the US. So we're no longer really just a regional player. It's allowed us to really expand our client base, which is helped us grow, as Matt mentioned. And there's a bunch of different things that we do, including fractional CFOs or controllers. Outsourced accounting is big, internal audit, and of course, a whole suite of technology solutions, of which Wherefore is a piece of that. And then also, some of you in this particular industry around food and beverage may be interested in a B Corp certification. So we were the first accounting firm in California to receive that B Corp certification. We just got recertified, and we have a whole sustainability group that can help you get to that certification if that's something that you would desire. Let's see, just a little bit on technology. So here's some of the different platforms that we work with. Between Sage Intacct and Wherefore and Blackline, Bill.com, we've got a great suite of services that we can help you with should you need some assistance in that regard. But really today we are here to talk about lease accounting. And so here's our agenda. We're going to cover the new leasing standard from the perspective of a lessee, not a lessor. We'll try to leave some time for Q&A at the end, but like I said, we're really paring down an hour-long presentation to a half an hour. If you need further information, our contact information will be at the end of this presentation, and we'd be happy to get on the phone with you and talk through any questions and see if there's a way that we can help. One of the things that we did to shorten the presentation was to move a lot of the definitions into the appendix. So you will get a copy of the slides at the end, which will help with some of the terminology, but we'll try to cover it as we go through the presentation as well. Okay, so in terms of effective dates for public companies, this really happened back in 2019. So it was effective as of 1/1/19 for them. And fortunately, it was delayed for a lot of private companies. So those delays have been resolved now. So it became effective on 1/1/22 for a calendar year-end company. And so if you have to report your financials at the end of the year, either through a compilation, a review, or an audit, you're going to need to adopt this new standard when you report at the end of the year. So here's a high-level overview of the adoption requirements. You can expect a lot more disclosure in your financial statements related to this, as is typical with any new standard that comes online. You're going to have some new policies, a discussion of the major assumptions, and the practical expedients that are going to be employed. And practical expedients are items that are supposed to make this easier to adopt. And there can be several practical expedients that are used. But Kevin, what's one of the most basic ones that you've seen through some of the work that we've done already?
Yeah, some of the basic practical expedients is the other non-lease costs that are included in a payment. Think of a triple net lease. You may have property taxes, insurance, maybe even some maintenance costs. So a typical CAM charges in a real estate lease. Some may be fixed, others may be variable. You have to consider the disclosure requirements for both the fixed portion and the variable portion. As far as the fixed portion, you have a expedient where you can include it in your calculation for your lease, or you can exclude it. So that is one of the options in your policy election. All of these costs need to be disclosed. You're disclosed in your financial statements, both the variable and fixed costs.
Okay, that makes a lot of sense. And companies are also going to have to choose how to adopt this new standard. And it's been a little bit of a mixed bag so far. So there's a couple of different methods. There's the modified retrospective approach or the comparative approach. And we'll cover that a little bit later in the presentation. Okay, so some things to consider. New standards are always a challenge for companies to adopt. And if you don't have a plan pulled together to adopt them, you may miss some critical items along the way. And so under 842, this is definitely going to be a multi-step process. So first, you really need to collect all of the leases and relevant contracts within your organization. And depending on the size and scope of your company, this may include people outside of your accounting department, such as legal or operations. So once you kind of have the team assembled in terms of who's going to need the help here, then you have to go and find all the relevant leases and contracts. And the contract distinction here is that you may have arrangements that weren't set up as leases, but may contain an embedded lease component under the new standard. So that's a mouthful. And the way I think of it for, perhaps some of you that are in food and beverage or that have worked with Wherefore. So for example, if you're using a contract manufacturer and that contract manufacturer has to buy a piece of equipment to just package or do something along the lines of getting your product ready, technically speaking, under this standard, you're leasing that piece of equipment. And so that would fall in scope here. So that's kind of one of the ones that's a little bit tricky. The other one would be, in the IT arena, if you've got a dedicated server that you're leasing, it could potentially be a lease there as well. I won't underestimate how difficult it could be to locate the leases and amendments and contracts and all of that, depending on how old your company is. If you're a relatively new company, I think you're going to be in pretty good shape. But if you're a little more of an established company, you could have some challenges locating all the details that you might need in order to do this. So once you've got that total population, then you've got to review all those leases and contracts and identify the key terms, select your policies, and determine if there's practical expedients that you can use. You've got to figure out the discount rate, and then, as Kevin was mentioning, the variable components that might need to be disclosed and or baked into the calculation. And then let's not forget that you've got calculations that need to be made, and footnote disclosures that are going to need to be made. And by the way, those calculations are going to lead to journal entries. And unfortunately, this isn't one of those situations where you calculate it, you book it, and then move on. There's going to be ongoing maintenance. So think of things that happen in the normal course of business. You've got contract modifications or lease modifications, perhaps terminations, you've got variable lease terms. All this stuff is going to need to be tracked and disclosed in your year-end footnote reporting. So unfortunately, there's a little bit of complexity here.
Let's not forget processes and controls. There'll be changes in your process in order to track these payments and track the agreements. And also contracts that may be entered in the future. So there needs to be a communication between your operations and your accounting department.
Yeah, absolutely. And from the reports I've seen, it sounds like there's an expectation that about $3 trillion worth of lease liabilities with a corresponding right to use asset will get recorded as a result of adopting this new standard. So lessees will be the ones that are going to be most impacted. And there's two concepts that I think are really important here, and they're highlighted on this slide. So contracts that a company enters into will need to be examined to determine if they are a lease or contain an embedded lease. And a physical asset has to be identified in the contract. Lessees will have to have the right to control the use of that underlying asset, and control is defined as being able to take substantially all of the economic benefits of the asset through the lease term and also directing the use of that asset. So if both are not met, then you don't have control and the contract is not considered a lease. And then also a lessor can have the ability to substitute an asset. So lots of information there that may require further discussion.
Yes, and to do this, there's what we've considered 6 steps to success. And to start with, you need to review all your existing contracted payments, your reoccurring payments, by reviewing your general ledger and your payments, and then inventory those contracts and the terms of those, and look out for the fixed and variable payments. Also look out for index payments, which increase each year based on a fixed rate. Next to consider is your policy selections to be disclosed in the footnotes. And then evaluate lease terms and what's management's plans. Do they plan to exercise options? Do they plan to exercise renewal options? Lastly, consider your adoption method. There's the effective method, which is easier, which you apply in the current year of adoption. So the transition is a lot easier. You don't have to go back and adjust your prior year. And there are transition relief, which means that under the old standard, a operating lease will be a operating lease under the new standard, and a capital lease under the old standard will now be what they call a financing lease, which is the same under the new standard. So there is no reassessments of your classification of leases.
Yeah, no, that's great. That will significantly help with the transition now. So as you can imagine, we've got an offering set up around this, and we've really tried to simplify our approach and the services that we can offer so that we can kind of give something to everybody here, right? Some companies may want to outsource a lot of this. Some may just need a little bit of assistance with portions of it. If we are more involved, clients will need to ensure that they take full ownership of the process. That goes without saying. So let me walk you through these boxes real quick. So we've set up these offerings, like I said, to provide some options, excuse me. In year one, we expect companies may need a little more hand-holding than the ongoing years. Some companies will have a great implementation plan, others will not. Some may just need a little bit of help with perhaps implementing a tool, and we do have a tool, a software tool that we think will be very helpful here. Some may need help with just the footnotes or running some calculations. And we can basically provide, either end-to-end consulting here or just help out where you may have some questions along the way. We try to keep it simple because we know that adopting new statements can be a challenge, and the last thing we want to do is add more stress and strain to the process. And one thing to think about, so if you think you've got variable leases or potential embedded leases, that's really where you may want to try to engage with, a third-party provider to help, because it's one of these things that builds upon earlier steps. So if you miss something in the initial steps of identifying what is or is not a lease, then by the time you get to the end, you're going to have bad information. So it's kind of that concept of garbage in, garbage out, right? If you don't get it right from the beginning, you may get to a bad answer at the end, which could lead to a potential restatement down the road. And as I mentioned, on some of the embedded leases, like an IT service contract, if you're a company that has that, right, where you've got someone doing some hosting or providing some servers to you, that could be an area that needs some further evaluation. And definitely if you're in the contract manufacturing space, where the contract manufacturer may have a piece of equipment that's being used just to take care of your business. So here's just a quick recap. The end of the year is only a few months away. It'll be here before we know it. My suggestion is to try to get out in front of this, whether you want to do it on your own or need some additional help. We're just trying to spread the knowledge that this is coming, and you may need a little bit of assistance here. So we've got kind of our 6-step plan and some other tools that we believe will help companies be successful in adopting the new standard, and we're here to help. So we've got a landing page on our website, and that's what you'll see on this slide right here. And when you get the slide, you'll have full access to that. And if you'd like, we can set up a 15-minute call to kind of run through your situation with you, let you ask some real pointed questions that are specific to your situation, and see if there's a way that we might be able to help you or get you pointed in the right direction. That's really what we want to do, be a useful tool for Wherefore and their clients, so that you guys can have a successful implementation and not have to worry about this kind of stuff. So with that, we'll break for a second here and see if there's any questions that you want to put into the Q&A, or if anyone wants. Can we let people unmute, Dee, since we only have a few people on the line, and see if they want to ask a question directly?
Yeah, if somebody raises their hand, we can go ahead and allow them to talk.
I know we covered a lot of relatively technical information, so you may be reeling a little bit and still trying to digest things.
I have a question for you guys.
Sure.
Based on your experience and the companies you work with, how common is leasing equipment versus buying, do you think? What's the typical or most common decision point that you see?
Well, I think, and that answer may be changing a little bit right now, Matt, as interest rates start to move around, right?
Mm.
And, typically what we see in a company's life cycle is when they first start out, they're not going to go and invest in equipment, right? Because they need capital to purchase raw materials and keep, going on with R&D. Once they kind of get a product that they know is going to work in the marketplace, I think that's when they start to look at that. Early on, a lot of companies will generate losses. So necessarily having an asset that you might be able to depreciate or take advantage of accelerated depreciation doesn't really make a lot of sense. So there's a lot of factors that go into that analysis, and that's something that we can talk with companies about too. But I think generally speaking, earlier on, we see a lot more companies lease versus buy. until they kind of get to that scale where they're confident that, what they're doing is going to take off and be sustainable.
Yeah, that makes sense. Do you see challenges with leasing, in terms of leases gone bad, so to speak?
No, I mean, leasing an asset, obviously, there's risk with doing that. There's risk with buying something. It's really, it's got to be based on the facts and circumstances for each individual company. And, for some companies, it may make more sense to buy. It also depends on what's the cost of the asset that you're talking about too, right? And can you find used equipment, now coming out of the pandemic, I have to believe, that there's a lot more used equipment floating around out there, which may be a little more economical to get your hands on. The other thing that's going to factor into that is, do you have a facility that you're already leasing where you can put such equipment, right? Or are you still kind of, in the early stages where you may be working out of somebody else's kitchen, if you're making a food product, or, if you're using a third party co-packer or whatever you're doing to get your product out. That becomes a whole series of questions that need to get answered. And like I said, it needs to have some analysis, and you've got to consider the tax implications as well. I had a more established company that manufactures a product, and we've been having these types of discussions with them, right? They're thinking of expanding, and they're looking at potentially going out and buying another company, buying equipment, and then we brought up the leasing issue with them. And so for them, they're very profitable. So actually buying the asset is probably going to make more sense, because they can take advantage of some accelerated depreciation, and they've got a product that's already well established. So, there's a lot of factors there.
Yeah, that makes sense. I'm wondering, for companies that do work with co-manufacturers, one of the things that I learned today is that if the co-manufacturer buys equipment, for my use, then I'm still kind of on the hook for accounting for that. Is that, it wasn't clear to me if that was 100% my use, or if they use it, say they use it 80% for me and 20% for someone else. How much does that affect my situation?
It talks about the concept of the right to control that asset. Kevin, do you know if there's a percentage applied to that concept?
Oh, the right to control? There's
so in a situation where you've got an asset at a co-packer, like, think about it, if a company has like a special packaging that they put their product into, right? A lot of times a co-packer may need to go buy a piece of equipment to actually package that product. And technically speaking, I think, Matt, more often than not, what we see is that particular asset is basically used 100% for just that one client.
Okay.
But I think it gets back to that concept of control.
Yeah, it comes to the concept of whether they control the use of that asset. And so if they have full control of the asset, then it becomes a lease. If that asset is used for multiple people, I don't think they look as full control.
Yeah,
Okay.
I think that's correct.
Yeah, it's interesting. A lot of our customers will, have some pretty specific packaging that they use in their product, and some of that packaging can require some fairly specific and specialized equipment to do. And sometimes it's not even just the equipment; it's the know-how.
Yeah,
Use it and keep it maintained and running, because some of this equipment comes from different countries, and
Yep.
We had a pasta company for a while that used equipment from Italy, and had struggles with, it would jam all the time, and that there was some knowledge about how to unjam it. So yeah, it's a tricky business, manufacturing, for sure. Leasing is one of those tricky areas to deal with as a company. So yeah, it's good to know.
Yeah. I'll mention one other thing too, and this may be a relief for some of those on the line. So if you're a relatively small company and you don't need to report on your financials externally, so that would mean, an audit review or compilation that perhaps goes to a bank or goes to investors, you don't necessarily need to adopt this right now. And you may want to wait until you get a little bit bigger. So you just wouldn't be able to issue what's referred to as a GAAP-based financial statement at that point in time. But for those that are just starting out, that are, trying to get their product up and going, trying to get the company propped up, you may just want to forego this for a little while if you can. But if you have to issue an audit, a review, or a comp, then you are going to have to do that. And so I see Grant's got a question there. Are we willing to share some resources for journal entries, T accounts, monthly entries, and such? So I think on our website there's some Q&As and some there's like a one-pager D, I think, that we've got that may provide a little bit of useful tips there. But as I mentioned, we have a software solution, and if this is something that Wherefore can't do. So Wherefore is a completely different software application. I liken this to, perhaps using ADP for payroll or Bill.com to automate your AP. It's not something that Wherefore does. So we do have a software solution that's a relatively inexpensive way to help you get through this. So if you've got questions, we'd be happy to set up a call, Grant, to run through some of that with you. At the end of the slides here, you'll get our contact information. So feel free to reach out on that. Anything else? Oh, and Dee just put a link to the website in the chat, so you guys can have that. And like I said, we're more than willing to set up some calls to run through questions live with you guys to see if we can help you and at least get you pointed in the right direction. Okay, so we're coming up on time right now. As I mentioned, we're going to have in the appendix the definitions that we talked about, so you guys will get access to this when the slides get distributed a little bit later today or tomorrow. Like I said, if you have questions, feel free to reach out. My contact information is there. Matt's contact information is there as well. So we appreciate you guys listening in. If you want to get the full version of this, plus the rest of the series that we've done, you can go to the Sensiba Sanfilippo website link. And you can also go to our YouTube page. And if you follow me on LinkedIn or follow the firm on Facebook or LinkedIn, you'll get access to the upcoming webinars. We're going to redo this entire series over the next couple of months, kind of going from beginning to end on lease accounting. So there'll be plenty of resources out there should you need it. So with that, we'll say goodbye and thank you all for joining the webinar today. And please reach out if you need any help. Thanks.
Thanks, everyone.
Thank you.